Welcome to Killik & Co.'s podcast. This is the 8th of July. Follows a very busy week for markets. Last week we heard from the Bank of England and also from the European Central Bank, and both had very similar messages to the market, and both were countering some of the sort of tapering comments that were coming out from the US and from Ben Bernanke from the previous month. The main message was clear: interest rates are going to remain low for longer than the market thinks in the current data. Indeed, they're going to keep the stimulus going quite strongly for markets, and as a result of that, we saw some very big swings in asset prices. Stocks rose, currencies weakened, particularly UK sterling, and of course yields over here did temporarily fall. However, countering all of that on Friday was some strong jobs data in the US. It continues the theme that the US recovery at the moment is still well entrenched, and on Friday we saw a bigger move to the upside on US Treasury yields. They moved to 2.7%, and we'll take a look at that chart very shortly. But interestingly, equities still managed to recover or rally through that particular period, and maybe we are at a crucial turning point for financial markets. Let's take a look at some of the forward data for this week and really key events for us. In the UK, we'll be looking at some retail sales data, but of more significance will be the meeting minutes from the Federal Open Markets Committee meeting, which took place, where they left interest rates unchanged. These details will be studied for any sort of further confirmation of tapering relief in the US markets. On Thursday, we have trading updates from a few of the UK businesses, but I think the key is that the US reporting season will start with Alcoa coming out in the course of Tuesday. Finally on Friday, so you have some further US sentiment index, University of Michigan consumer sentiment being the sort of main feature for the day. We'll also hear from Draghi. He was talking last week following the ECB decision. He'll also be talking tomorrow, and again it's going to be closely watched for further dovish signs coming out from the euro. So let's take a look at some of the charts that will be of interest. The starting point I mentioned was how weak sterling was last week. Mark Carney has certainly made his impact felt much earlier than expected. There was a feeling around that he's only been in the job for 3 days, and he may leave it until the August meeting before making any committed signs. But the fact that he referred to the fact that interest rates were not indicating what he was seeing coming from the data suggested he was much more dovish in his approach. A good first start for him, and certainly the impact was very severely felt in the currency markets, where already we're starting to see the sterling back down to the lows last seen in March of sub 150 and indeed sub 149. Some weekend comments around that we could be hurtling lower down towards 140 at the moment. Good for exporters, yes, but we're not particularly a big export country. We do import a lot of our goods, and so this is not the holy grail of economic recovery. Indeed, one of the areas of concern about lower currencies is that inflation will pick up, and of course inflation is one of the key pieces of data when assessing interest rates at the moment. So as I say, it's not an all-win situation from last week. In terms of sterling, we also look at it from the euro's perspective. A much less signal there that we're weak against the euro, and that of course is represented that the euro also had a weaker session during the course of last week. Turning to yields, well, this is the chart. I'm going to keep featuring it because it is so central to what is taking place at the moment. When we started looking at it, we were really stunned to see that the US yields were moving above 2%. Well, it's 2.7% now, and seems very much heading towards 3% as the next stop on the chart at the moment. But interestingly, as I pointed out, that move really from 1.9 up to 2.4% sent equities very much into decline, and we saw 10% moves to the downside on UK stocks, but we've recovered by 5% of that move, and it looks like this latest move higher at the moment has left equities very much undisturbed from their current upward trend. So hopefully a good sign that it's able to absorb these higher yields for the right reasons at the moment. So the FTSE As I said, volatility very much on the increase at the moment, but we're creating a bit of a V shape at the moment and recovering over half of those falls that we've seen during the course of late May and early June. Turning to some stocks, one sector that I think is continuing to show some very good momentum to the upside at the moment is the house building sector. We've had trading updates from Taylor Wimpey, from Redrow, and indeed we had them from Bovis Homes this morning, and really everything is moving in their direction. They're buying land more cheaply, they're getting more volume through in terms of houses sold as the mortgage market is beginning to free up, and house prices generally, they're moving the average selling price up at the moment. The combination of all of that means that profits are running well ahead of expectations for most of the house building sector at the moment, and of course it is the house building sector to some extent which the government is using as a sort of starting point for economic recovery, so some good signals coming out from that market. Also worth highlighting the banks. Most of the banks have actually had a pretty torrid time of late, with stocks like Barclays hitting sort of 2013 lows of around 270. But Lloyds continues to move very much to the upside at the moment. It is now trading comfortably above the government's sort of average in price, taking into account all the fees they've earned from Lloyds Bank over the period. And indeed the weekend press was speculating that the Singapore Wealth Fund was keen to approach them to take out possibly a 10% stake. Pure speculation at this stage, but momentum very much with Lloyds at the moment to the upside. Turning to some things that are trending lower at the moment. Samsung had a pretty poor week last week. Normally Samsung are very good at raising guidance for their quarterly sales, but this time those heightened levels of expectations were not met and the numbers came in quite shy of expectations. So we've got a little bit of a downtrend taking place here, and interestingly a little bit of an uptrend taking place in Apple. So there has been a period now since September of last year where really the two companies have seen sort of opposite trends, but those trends may well be reversing in the near term. One to watch. In terms of other stocks, we recently produced a thematic note on the e-commerce sector. One of our stock picks was Visa, just highlighting that there's been a little bit of a breakout there at the moment. It's quite a hot off the press piece of research for the e-commerce sector, and as I say, Visa being one of our preferred choices there, so possibly worth picking up a copy of that note during the course of this week before that momentum carries on much further. Just a few commodity stocks I want to sort of pick out at the moment. Oil is picking up. Just keep half an eye on this one. Oil has played a pretty low profile in the course of the last few weeks and months, but as oil starts to rise, the oil sector for one has been quite weak. That may herald a little bit of a turnaround for the sector, but more importantly it does act as a tax on business. So of course if we're just all talking about economic recovery at the moment, it might not take long for oil to start to put a bit of a dampener on that conversation. We're also just keeping an eye on some of those harder commodities such as copper and also gold at the moment. No signs that the downtrend is changing there for those two commodities, and that's really in the case of copper a China story at the moment. We will have data out from China this week which is going to be sort of reasonably sort of closely watched for any signs of continued faltering in that particular economy. Just a couple more to finish. It's all about Japan. I just think it's worth mentioning that the weakness in the Japanese yen has resumed again after that sort of bout of profit taking. The upward trend is continuing. We may well be quite close to breaching those sort of high levels seen, and if we start to move to upside, Japan's going to come back very much to the fore. Keep an eye on Thursday. Bank of Japan will be reporting its interest rate decision, so time for Japan, as I say, to take more centre stage again. The Nikkei has rallied. It had a poor night last night, but it's coming off the lows at the moment. We still do like Japan. But it's a volatile ride, unquestionably. But if that yen starts to weaken further, I can actually see the Nikkei becoming, as I say, a feature at the moment, and particularly for possibly some of the emerging markets around it.